A dangerous blind spot exists for many international sellers who focus exclusively on federal tax filings with the Internal Revenue Service while neglecting state-level obligations. The requirement to file an annual report with the Secretary of State is distinct from income tax filing and serves to maintain the legal existence of the company within its jurisdiction of registration. For entities registered in popular states like Delaware and Wyoming, failing to submit this report results in administrative dissolution. This loss of legal standing is immediately detected by e-commerce platforms through automated checks, leading to the suspension of selling privileges and the freezing of funds until the entity is reinstated. In Delaware, a common pitfall involves the calculation of the franchise tax, which can result in exorbitant bills if not managed correctly. The state defaults to calculating tax based on the number of authorized shares, which can lead to tax bills in the tens of thousands of dollars for companies with large share authorizations. However, most sellers qualify for an alternative calculation method based on assumed par value and total assets, which significantly reduces the tax liability. Sellers must actively file their reports and select this alternative method by the March deadline to avoid the default high tax and substantial late fees that accrue monthly. Wyoming presents a different challenge with its dynamic deadline system, where the annual report is due on the first day of the anniversary month of the company's formation. This lack of a uniform deadline makes it easy for sellers with multiple entities to miss a filing, leading to automatic penalties and rapid administrative dissolution. Once a company is dissolved, it ceases to exist as a legal entity, rendering its contracts void. Reinstating a dissolved company is a costly and time-consuming process involving fines and paperwork, during which time the seller's Amazon account remains suspended and inventory may be at risk of removal. California imposes an aggressive minimum franchise tax on any company that is registered or doing business within the state, regardless of profitability. Every active entity faces a mandatory minimum annual tax, which accumulates with interest and penalties if unpaid. Sellers often mistakenly abandon their California entities after ceasing operations without formally dissolving them, creating a growing debt liability. Furthermore, the loss of good standing at the state level exposes the business owner to the legal risk of piercing the corporate veil, meaning personal assets could be seized to satisfy corporate debts or legal judgments, defeating the purpose of having a limited liability entity.